Chapter 10 deals with taxes, and as does Chapter 11. Chapter 10 is really more the basics of taxes. Chapter 11 focuses on retirement plans, and it contrasts like a 401k plan versus a regular IRA versus a Roth IRA. Taxes are a complicated subject, and I'm only just touching the surface here just to introduce you to the topic. So don't think that you'll know everything about taxes after you watch this lecture and read the chapters. So, starting with the basics, taxes are probably the biggest expense you'll ever have in your life. So, just to show you how much taxes can impact your wealth, let's say that we invest $10,000 and we invested this for 50 years and we earn 10% annually before taxes. What I want to do is calculate my ending wealth or my future value. And this is a lump sum. I'm never adding any more money to it, so it's not an annuity. So this would be as an example like the money my kids inherited. I could not open a Roth IRA for them because of the way the Roth IRA rules work. And I couldn't even open a regular IRA for them. Basically, I just had to open a regular account, and they do have to pay taxes on various things throughout the years. So to find the future value, it's the basic future value lump sum equation, which is the present value times 1 plus the rate raised to the power of time. And so I'm just going to raise that to an exponent. And now I'm going to pop in the numbers. So what we know is the present value is that 10,000. Multiply that by 1 plus the rate of 10% raised to the exponent of 50. And when I crunch that, I got a future value equal to $1,173,908. That, though, is the before tax rate. Essentially, my kids have to pay taxes on any dividends that they receive in the year that they get the dividends. If they sell an investment and reap a gain on that investment, they have to pay a tax on the gain the year they sell the investment. So let's say that they are in a 20% tax bracket. They are not. I'll talk about tax brackets later. But just for the example in this problem, let's use a 20% tax bracket. So if they have to pay the 20% from that 10% return that they earn every year, then their after-tax return is going to be the 10% before tax return times 1 minus the 20% tax rate. So what this is getting at is they're only netting 80% of the money that they earn because 20% of it has to be paid to the IRS. So if I take 80% times 10%, I get 8%. So that's their after-tax return. Now I'm going to redo this formula but use 8% instead of 10%, which is obviously going to lower my future value. So this will become 0.8, but still to the power of 50. And I got a future value. It makes us an astonishing difference. $469,016, assuming I did all my math right. So that's why taxes will probably be the biggest expense you ever have. This isn't the expense, this is the difference between this return, our value, and this value is all due to the fact that taxes have to be paid. This is why so many people are interested in lowering their taxes. Now, I also want to just go through and do a basic, very simple tax return. And I'm not going to do an official tax return. I'm just going to kind of work it in Excel, actually. So, but there are a few things that you need to know. Everybody has what they call a personal exemption. That amount changes, I think I can safely say, virtually every year. So I looked it up and I just don't remember where I had it. Here we go. So this is the IRS website, and there are other sites where you can find this information. But here's the information on the personal exemption, and hopefully I can see what I'm highlighting. So the personal exemption for 2015 is $4,000 per person, and like if you have children who live with you and they meet certain rules established by the IRS, then you can claim an exemption for them. If you're married, both you and your spouse can claim an exemption. Again, there are rules that have to be met that I'm not going to go into. And you can see that's gone up by $50 from 2014. But this exemption phases out the more money you make. After you reach a certain point, you won't be able to claim this exemption, but it does require fairly high income levels before it phases out. So we're assuming that you're a single individual, and there are different tax rates for single people versus married people versus head of households and versus married people who file separately. So in this example, I'm assuming you're single. You also get a standard deduction, and that's listed right here. The standard deduction is for single people $6,300, and that's up from $6,200 last year. So I'm just going to jot those bits of information down. So the personal exemption is 6,300, standard deduction, oh, I think I wrote that backwards. Standard deduction is 6,300. Personal exemption is 4,000. And again, that's for 2015. In 2016, it'll change. So what you do is you have to input your income that you generate. Different things count as income. Dividends that you earn on stock are technically income, but they actually let you pay a capital gains rate on that. I'll talk about that later. But let's assume you make $29,000. Then you get to start subtracting different things. One thing you get to subtract is your personal exemption. So I'm going to subtract the $4,000. And actually I'm going to put it as I'll put it as a positive 4,000. You also get to subtract your standard deduction, or you can itemize your deductions and subtract that. If your itemized deductions don't exceed your standard deduction, it's not really worth it to itemize though. And so this amount will be your taxable income. So I'd take my income, subtract my personal exemption, subtract my standard deduction to get taxable income of $18,700. So this is the amount that I owe taxes on. And again, I'm making this very simple simply because I know from previous experience a lot of students who take Finance 216 have never completed a tax return. So I'm just trying to explain the basics of it. You know, anything that we can do to reduce our taxable income lowers our taxes. So that's why we like this personal exemption and this standard deduction. But now I need to figure out my taxes. And I'm going to come over here and do a separate calculation because it's not that simple. And it's also not on that website. So here is the 2015 tax bracket for a single person. And you can see it has different levels. Income that you make that falls in this range from 0 to $9,225, you'll be taxed at a 10% rate. Income over 9,225 but up to and including 37,450 will be taxed at a higher rate, 15%. And as you make more money, you get taxed on that income at a higher rate. So the US has what we call a progressive tax system. The rate that we pay on each dollar of income rises, going from a low of 10% to a high of 39.6%. So, and this is for a single individual. And you can see the rates over here in this this column, the one on the left, are identical, but the dollar amounts that make up the brackets change if you're married filing jointly versus a single person. And again, there are different brackets for head of household and married filing individually. So let's calculate this person's tax amount, dollar tax amount. So I know on income from 0 to 9,225, they pay 10% on that. So I'm just going to pop over to Excel. And so they do make over 9,225. So I'm just going to type that number down and the rate that they will pay. And so from any amount above 9,225 to $37,450, they're going to pay a 15% tax rate on. Now I've already forgotten that number. I have to look it up again. 37,450. And that's a 15% rate. Now their taxable income is only 18,700. So some of it will fall in this category and some of it will fall in this category. They don't quite, they don't make anywhere close to the 37,450 that would switch them to the next higher bracket. So first I need to figure out the income they're going to pay on the first $9,225 of their 18,700. So I will take 9,225, multiply it by this 10%. Then I'm going to take the difference, since this is since their 18,700 now falls below the 37,450, I know that they're going to pay 15% on any amount that they owe between that's over 9,225 and up to 18,700. So what I'm going to do is take the income they did generate, subtract the 92.25 because that tax amount's already been calculated to be $922.50. And I'm just going to hit return, and I'm not quite finished, but this gives me a number to talk about. The $9,475 is how much more they made above 9,225. So 9,475 is how much more they made above 9,225. And this amount, 9,475, will be taxed at this 15% rate. So now I'm just going to take that amount and multiply by the 15%. And I'm going to change this, but then in a minute I'm going to hit undo. Let's say they had made $35,000 right here as a taxable amount. They would still owe 922.5 on the first 9,225, but then the tax that they would owe on the amount above 92.25 would change because they made more money. So I'm just going to type in 35,000 here, which I know is not the correct answer, but just for the sake of demonstrating, when I hit enter, look at what happens to these two numbers right here. The first one didn't change, but the second one went up by quite a bit because this number represents how much tax they owe on this value that's above 9,225. But now I'm just going to hit undo to get it back to where we need it to be. Now if they had made more than $37,450, I'd have to put another bracket here because they would have to pay higher than 15%. The next bracket I believe is 20%. I'm just going to pop over and look at that. So actually the next bracket's 25%. It goes up a lot. So if they had made, let's say, $40,000, just for the sake of argument, I'm going to show that too. So 90,750 and 25%. So any amount above 37,450 but below 90,750 is taxed at a 25% rate. So if they had made, again, I'm just going to make this 45,000 just to demonstrate something. If they had made $45,000, then The amount between 92.25 and 37,450 would be taxed at 15% rate, the rate 15% rate, but any amount above 37,450 would be taxed at the 25% rate. So this calculation is now incorrect because it says look at the 45,000, subtract the 92.25, and then take that amount and multiply it by 15%. But that's not right because the amount above 37,450 needs to be taxed at 25%. So what I would do is take 37,450, subtract the 92.25. That's going to give me $28,225, and that's the amount that's taxed at 15%. And then any amount above 37,450 but below 90,750 is taxed at 25%. So they make 45,000, subtract the 37,450, and I need to put that in parentheses, so it'll do that first. So they made $7,550 above 3750, so they have to pay a 20% tax, 25% tax rate on that 7550. So I'm just going to multiply that by 25%. So their total tax would be the sum of all these values that I've highlighted. Now, this isn't actually correct, so I'm going to just hit back a couple of times to get it to the right spot. And I believe that's it. Yep. So, to figure out their total taxes owed, I would just sum these two numbers, and I'm actually going to do that over here. So the 922 plus the 1421 gives me the taxes owed, and that's actually generally where we stop. So that's the taxes that this person would pay, and usually it's deducted from your paycheck periodically. Another thing that's interesting to note is your average tax rate. That is equal to your taxes that you pay divided by your income that you generated. So because of the personal exemption and the standard deduction, you didn't owe taxes on $10,300 that you earned. But your average tax rate on your entire income is 8.08%. And actually I'm going to be very explicit on entire income. And I need to do that. And then your average tax rate on your taxable income is going to be the taxes that you pay divided by your taxable income. So 12.5%. But what they call your marginal tax rate, and I'm going to pop over to here again to explain that, because there are different brackets and rates that are charged. Again, I'm looking at the leftmost column over here, even though it highlighted multiple columns. The marginal tax rate is basically the actually, I'm going to restate that. You pay multiple tax rates. On the first $9,225, you pay 10%. On the next group of money that you make, you pay 15%. But if you fall in the third bracket, this one right here, you pay 25%. But not on your entire income, just on the income that falls above $37,450. Some of your income you pay 15% on, some of your income you pay 10% on. But your marginal tax rate is the highest bracket that you fall into. So if you generated so right now let's say you make $40,000 in taxable income. If you generate another dollar of taxable income, what rate are you going to pay on that? Well, that'll still keep you in the 25% bracket. So you would pay a 25% marginal tax on that amount. So the marginal tax rate is going to be the highest bracket that you fall into when I look it up on that table. So in this case, the marginal tax rate was 15% because they didn't earn enough to pop them into this bracket because they only earned $18,700, so they paid 10% on $9,225 and 15% on the amount above that they earned. So their marginal tax bracket was 15%. Now, dividends and capital gains are taxed differently than ordinary income. So if I pop us back over to this graph or table, it points that out. There's on the left the tax rate on ordinary income. Those are the brackets I've been talking about. But on the right, there's something called the tax rate on qualified dividends and long-term capital gains. Basically, if you own stocks in a US based corporation or a mutual fund and you receive dividends on those investments, those qualify. There's a long list of things that distinguish between qualified dividends and unqualified dividends. The report you receive from your broker or your mutual fund company will state whether your dividends are qualified or unqualified, and probably for 99% of you they'll always be qualified. I'm I'm only touching the surface. I'm not going to go through the list of what makes a dividend qualified versus unqualified. And then if you own an investment for greater than a year in a taxable account, then you get to benefit and pay a lower tax rate. So if you compare the rates in the rightmost column versus the leftmost column, you can see the rightmost column rates are smaller. And so we would rather pay lower taxes than higher taxes. Dividends and long-term capital gains benefit from this lower tax rate compared to the higher tax rate. But let's say I own a stock and I sell it after I've only owned it for 3 months and it's in a taxable account. I don't benefit from these lower tax rates. I have to pay the higher tax rates on the gain. So short term capital gains get taxed as ordinary income and they fall in the leftmost brackets. So let's say that we bought stock in Ford, um, and we hold it for a year. And that's going to make it then a long-term investment. And it Ford was priced a year ago at $14.17, and it's right now priced at $14.57. And I can see, based on these blue diamonds down here, that it paid a dividend 4 times during the past year of 15 cents per share. So let's say I buy 100 shares of Ford, and I think I'll do this in Word. So I buy 100 shares of Ford at $14.17 each 1 year ago, and I sell them today for 14.57, I believe it was, each. And then Ford has paid 4 dividends over the past year, and it was 15 cents each. And and actually, I'm going to just very explicitly state that these are qualified dividends. So that means they classify as receiving the capital gains rate. And let's say I am in the 25% ordinary income tax bracket. Based on that information and the fact that I sold it after owning it for 1 year, that makes the gain that I received, because I did receive a gain and I have to pay taxes on that gain. That gain, though, is classified as a long-term capital gain. And the amount of that gain is going to be the 1457 minus the 1417. So that's a gain of 40 cents a share, and I own 100 shares. So I have a gain of $40. And then the dividends will be classified as a, I only have to pay the long-term capital gains rate. So they're taxed at the capital gains rate as well, which again is a good thing because it's lower than the ordinary income tax bracket. And so my dividends total 15 cents a share, paid 4 times, and I own 100 shares. So that's 60 cents times $100, that's $60. Since both the $40 and the $60 are long term capital gains, I can just total those. So, total long term capital gain amount. So, I have a total of $100 in capital gains. If I am in the 25% ordinary income tax bracket, I need to find out what um, capital gains tax bracket that puts me in. So I'm going to go back to this table. Here I am at the 25% capital or ordinary income tax bracket. So that puts me at the 15% capital gains bracket. So I will owe 15% on that $100. So to calculate my taxes, so I'm going to put determine capital gains rate or gains tax bracket. And for us, that's 15%. So now I'm going to calculate my taxes on the $100. So it's $100 times 15% or $15. So that's how much I'll owe in taxes on that. Now I want to point out something. When I buy my 100 shares of Ford, I have to pay $14.17 times 100. So the cost is $1,417. And then when I sell my 100 shares of Ford, I will receive $14.57 times 100 shares. So I'll get $1,457. I don't pay taxes on the 1457. I pay taxes on the difference between the 1417 and the 1457. That difference is $40, which is what we calculated up here, our long-term capital gain. So some people accidentally pay taxes on the entire amount received, but that's not the way it works. You only pay taxes on the gain. All right, there's a lot more to say about taxes, but I'm going to do this in a series of videos.